A very warm welcome to everyone on yet another episode by reitspro.com, where we try to give you plenty of insights on REITs and InvITs in the Indian context. So for those who are not familiar with REITs and InvITs, you can pause here and go to our site also and connect with us and see what REITs and InvITs are about. And for our older viewers, we'll go ahead and explain some common REIT terms today. Some of you may be familiar with these terms, but some could be new to you. So let's go on and explain to our REIT and InvIT investors who are struggling with some basic words and what is their deeper meaning. So as an example, some common terms are: there are units of REITs and InvITs. Unlike shares of other companies, there is something called the NAV. Then there is a book value, a market value. What is the difference between all these? And then there is net operating income, and what's the difference with earnings, and what is DPU versus dividend, and what is something called WALE. And there could be others also here, but we are going to now come on to the basic and common terms and get deeper into those. So we will try to de-jargonize, simplify, and use it so that you can apply it better. And you can also join our discussion group on WhatsApp. The link is in the description of this video. Plus, you can visit our website for more insights such as blogs, books, and more. And I would again introduce myself. I'm Gaurav Jain, and you can also buy these two books online, which are at the asset level, what real estate is, and REITs and InvITs. In the stock markets, it's about REITs and InvITs. So there is a first set which we would talk about in de-jargonizing, that's related to equity of REITs and InvITs, and then a second set which would be earnings of REITs and InvITs. So these are the two things we would talk about. So the first set is what is about the four different things here, which is unit versus shares first. So what are the units of REITs versus shares? So as you all must have seen in an earlier video, there is no face value. Why? Because it is not a regular registered company, but it is a registered trust. That's the first difference. So legally it is a trust and it is bound by sebi guidelines. Therefore, the net assets divided by price per unit, price is as per marketable lots, which we will just explain, and each price is guided by marketable lots, and that's how you get a unit. So there is no face value, but the closest you can get is to the IPO price, which is calculated in a certain way, which were earlier sebi guidelines that they have been changed, and we'll just explain that also. So as per the earlier guidelines, the REITs could not accept subscription amount of less than 2 lakh rupees. This is an excerpt from the earlier guidelines, and the trading lot would be 1 lakh rupees. So what really happened was that, for example, Embassy Park REITs in 2019 April, the guidelines, to comply with the guidelines, they had 800 units priced at around 300 rupees. So that made it 2,40,000 complying with this guideline. And then the trading lot was 400 units. Of course, subsequently it went out to 200, and today it is 1 unit only. But at that time, that's how it was governed, and that's how the price came of 300 rupees. And that's how it's called a unit. A little similar to mutual funds, but not like companies. So if you see this HDFC Securities snapshot here, the price band of 299 to 300 is there, where there is no face value, and the bid sizes given here as well as the multiples thereof for trading purposes. Next, if you see here, this is a Brookfield snapshot. Now here the regulations were changed, so the regulations then were halved to 1 lakh rupees and 50,000 for REITs. So in Brookfield's case, the issue size was different, the IPO was different in that case. The second part is very much related to the first part, that is the NAV. What is the NAV? Now that's again, as the formula is, as one was just explaining, assets minus liabilities divided by the number of units, and this is the fair market value. So the difference between this and this is that this is at the time of IPO, a fair value was calculated, something like that, and according to that, most REITs issued at a little discount of that, and that's how the units came about. And the net asset value of each unit is actually assets minus liabilities divided by the number of units, where this is a fair market value of the numerator here as at a particular valuation date. Now the third concept is the book value. Now this is a difference between the NAV and the book value here. So if you see the table here, the book value is a historic value. It's not the fair value. The fair value is different of the assets if you see here. So the net assets is different. So therefore, when you come on to the book value would be very different here than the fair value here. That's how the difference between NAV and book value comes about. One being historic in nature and one being on a particular time, the fair value of it. And then the third thing is the market value. So the unit can obviously be traded in the market for REITs, and that's how the fluctuations happen. So if I take a comprehensive review of the pricing, it's fluctuated from a certain point to a certain point and keeps trading at different levels. That's the market value. So they are related, but somehow they are also very different from each other. So that's the first set that we talked about. To summarize this first set, the unit versus share price, these are trusts and not companies. It's conceptually something like the mutual funds. So the total value divided by the total net value divided by the number of units would give you the price, or vice versa. The second thing is the NAV, the net asset value, which is the value on a particular date. So this is the fair value done, a valuation is done, and that's the net asset value. This is not the same as the market value. The market value could be different because that is traded in the markets at a particular buy and sell rate. And then the book value is a historical concept at which the price of units, which was at a historical value that is in the books, is what gives you a book value. Coming to the second set of our terms, there are three concepts, which is NOI versus earning, which is net operating income versus earnings. So net operating income is nothing but rental flows, the net rental flows that a REIT generates. So if you see the snapshot of Brookfield India REIT, this is the operating lease rentals and some maintenance charges and other revenues which they generate. So the revenue from operations, and from that a deduction of expenses is made, and some amount of net operating income is generated in this case. Now this is different from a consolidated, as you see in the consolidated financial statements, this is not for the same period. I'm not comparing period to period, but it's the same company, the Brookfield Trust. And if you see here, there are expenses such as depreciation or finance costs, which is not there in the previous statement. So here we are talking more about the cash flows here. So this is what the NOI was, net operating income. And the second part is also related to cash flows, because this is distribution per unit, and it includes dividend, rent and interest income, all cash flows. So it could be different from companies where the amortization and other non-cash expenses are then taken out, and then a particular amount is given out as dividend. Here the cash flows are upstreamed, and the third portion of that is WALE. But before that, let me just tell you that that's why we say that EPS is not relevant as DPU for unit holders. Okay, so the third part is the WALE, which it's basically a single figure to average the leases in place. So you have certain leases in a REIT, and this is a single figure which comes in years, and it gives an average amount of years in which the leases are in place. So next I will just show how it is calculated. So weighted average lease expiry, or it's also called the weighted average lease term. And to calculate it, there are three steps. Step 1, for each tenant you would do a current rent into remaining lease term. Step 2, you'd sum all these on the step 1. And step 3, you divide result from 2 by sum of current rent for tenants. So how do you do it? I'll just explain with this very, very simplified example. So if you see, this is ABC company, which is probably rented out some premises in for the REIT XYZ and RST company. So all the rents are here and they're totaled here, and lease time remaining for each is given here, and the rent into number of years, this column multiplied by this column is this product. And when you add it up, it is 87 lakhs. So 87 lakhs divided by 18 lakhs would give you 4.83. That would be the WALE, W-A-L-E, or weighted average lease expiry. So if you see the Brookfield, again the Brookfield REIT investor information sheet, so this talks about an 94% gross asset value in operating properties and a WALE of 6.8 years. So a video of that would be made separately, how they've consolidated. I'll do that, but this is a basic chart that they give out, that the WALE is 6.8 years in case of Brookfield assets. So as a summary, you have NOI versus earnings. So NOI is, unlike normal companies, NOI is a key figure in REIT. DPU versus dividend. Dividend can be a part of DPU. So it could be a part of DPU and it would not be the whole thing. Mostly it's about upstreaming all the cash flows to the unit holders. And the third is WALE, W-A-L-E, which is a measure of stabilities, that how much solid the REIT is in terms of its tenant profile. Not in terms of tenant profile, but in terms of how the tenants have committed themselves to the REIT. So if you like the video, do like and subscribe. You can also write in the comments section, write to us at this email ID. Thank you so much. Thank you for watching this video.